This is Mike Morton. I'm here with Mike Ray and Todd Johnson. This is our second podcast for the Platinum Group, and I'll let Todd get started by talking about what happened this week. Todd?
This week was interesting, to quote the Chinese saying, and a lot of ups and downs and swings and lefts and rights, and in general, I'll say that the portfolio, we made a number of changes, and there's a clear focus on moving to income names because the 10-year yield has dropped down, and I expect that yield to remain low for the foreseeable future. And I also added to some growth names like a Splunk. A Facebook has been terrific. Google, Priceline have been terrific. I'm really trying to add growth and income based upon the current market conditions.
Yeah, this is Mike Ray. Yes, I agree with Todd. The market was very interesting. Monday we had a major sell-off that really took off, that really put the jitters through just about everybody. Tuesday, Wednesday, relatively flat, made everybody nervous, and then all of a sudden on Thursday we started improving, and Friday we're so a real roller coaster ride we had this week. Todd, Friday we had those job numbers come out, and it was very interesting. We were really concerned about those job numbers, and I know that we had our hedging in place, and we were ready for the worst. And the numbers came out, and they were disappointing, and the market still bounced back.
I really don't pay attention to the job numbers. I know that the market does, so I have to, but I think it's well known that the job numbers can be manipulated in various ways, and it can be revised in the following month. So, I don't see a lot of job growth in the sectors that it used to be. There's a lot of job growth at Wendy's or the fast food places, and a lot of our jobs are still being outsourced to China and some of the countries where it's inexpensive for manufacturing and for high tech costs. So the end result is the job numbers can be good or bad, and then they're revised the next month. And I think most of us know that the job wages are fairly stagnant, they're not increasing. Thus, there really isn't a inflationary environment. I believe that we're in a deflationary environment, and only another reason for my conviction to own income producing stocks. I don't see housing prices going up a whole lot more from here. We're up to current levels approaching 2007 prices on housing in many markets. There's obvious exceptions, Detroit being one, and I hope Detroit does rebound, but that whole
Yeah.
okay personifies the U.S. in many ways. Many cities had their jobs go south in the U.S. or east or west to foreign countries, as it may be. That's sad for people that lived in Detroit and grew up in Detroit. But the winters in Detroit, as favorable as winters in Florida or Tennessee, and the tax situations have obviously changed too. In many ways, that reflects New York versus Florida in present day terms. Where do you want to live if tax is the only issue, New York or Florida? And many people would say Florida. New York obviously has its attributes too. In summary, the portfolio has equities with a lot of growth potential, both in earnings and revenues. A name like Splunk has 50% growth, and many of our new additions, the master limited partnership names, our close-end fund names, our just income names in general.
Let me ask you this, Todd. Here's an interesting question, and it's basically where we see the markets moving from here. We saw this, these highs coming off 2013. We saw all of a sudden now we've seen this sell-off, and every pundit we saw on the television was saying the same thing, and no matter what, it looked like we were destined for a sell-off, and we got it. And Monday, like we talked about, was just disastrous. And it looked like it was just going to keep going. And then all of a sudden, even with the, like we talked about, the bad jobs number, it just wanted to turn around. The question now is, where do we go from here? And and of course, if we all knew the answer to that question, well, we'd all be millionaires. But since the market seemed to look past that jobs number, I think since interest rates are maybe moving down, we might just grind higher from here. I'm not saying we're going to have double-digit returns over the next several months, but how do you feel? Do you think maybe this so-called correction is coming to an end? Was it a buying opportunity, or do you think there's more downside coming off?
Thanks, Mike. Yeah, I don't know. The reason I don't know is because in the S&P 500, many of the companies receive over 50% of their revenues in the emerging markets, and so many of the emerging markets, Turkey, being an example, they just have their own internal struggles with their economic situation, and so that will play a dramatic influence upon the big companies that have emerging market.
I understand what you're saying. I think the important thing here is and that's why we hedge, because we don't know. Are we going to grind up higher, slower? Are we going down? I don't know. As long as we have our hedges in place, I think we'll be okay.
Yeah, yeah, Mike, definitely. And the reason I say I don't know is because I truly don't know, and part of the reason we own a lot of the names we own is, I expect the market to move higher. I really do. I think most people in this country are hardworking people and want the best for their families, and they marry, they have children, they just want a happy life, and part of that is doing a good job at work. Economic and acute situations happen, such as whether it's a terrorist action or whether it's an economic collapse that we experienced, witnessed firsthand in 2008. If we just see a dramatic slowdown in any one economic sector, that can really put a dent into the stock price of many securities. And that's why I try to put on hedges on our positions, because negative events can happen. Fraud can happen with accounting issues, and that can impact a certain stock from going from a $30 to a $10 price per share. And that's the benefit we have by hedging, by reducing significant stock price losses.
For the audience out there, it's kind of let's get into a couple more of the names and some of the trades that we did this week that I thought that were actually pretty interesting. One of them, we got a starter position in Under Armour, which I thought was an interesting trade, coming in, especially, talking about the growth in Under Armour. And then as a trade that followed was the reduction in the Nike position. So, any thoughts there?
And Mike, as everyone knows, the newsletter, the Dividendlab newsletter is a newsletter. And my goal, or what I'm trying to do, is present ideas that represent holdings or non-holdings. Under Armour, symbol UA, just had an incredible quarter. They are just growing beyond belief. And they are just taking market share away from Nike in many sectors. And one sector that I believe will only increase as we go forward, simply because it's a new product, is the shoes, is where Nike really thrives. And Under Armour is going to enter that sector, and I think they'll make a big difference and will hurt Nike's shoe business. And also, Under Armour has a very low international revenue as a percentage of their revenues basis. I believe it's under 10%. And Nike, as we all know, is a global brand and has a global presence. Under Armour management wants the international business to be 50% of their revenues going forward, and that only means that the Under Armour stock price will continue to grow if management executes on their business plan, and that will take business away from Nike. And Under Armour, in my eyes, as a big Nike fan, both stock-wise and as a user of their shirts and their workout clothing, their shoes, running shoes, walking shoes, Under Armour is becoming a bigger presence, and we can see that on the football field, people wearing Under Armour equipment, and they are just becoming really an international star, and that will be expressed in revenue numbers going forward. Domestically, they've already been a star for the past few years, but it will grow with the Russian presence and with their professional sports endorsements.
I know we're coming to a close on this podcast, but there's another questions, and stuff that I'm even saying that's starting to interest me is, last week we saw, weakness in certain tech names. We saw Yahoo come off the $40 price and come down into around the $35 range, although that has made a strong move back. And then we saw, for example, this week we saw Twitter. Twitter, failed miserably,
Right.
and that didn't work. But then on the other side of the coin, we see guys like Facebook who actually, are doing successfully. I know we own a lot of tech names, and I think the tech is gonna once again be the place to be. Actually, watching the rebounds, but we'll have to be selective. Of those tech names, Yahoo. Do you have any feelings on how those might play in the portfolio?
Yeah, Google and Priceline are just dominant in their respective roles, and they continue to just execute on their business plan. And I simply love those two names, and we do own those positions. Facebook has become the number two advertiser on the internet space, overtaking Yahoo. And the reason we own Yahoo is
Alibaba, right?
yeah, correct. Yeah, some of the valuation. The Alibaba IPO should, according to the media reports, should occur in the next few months or be announced in the next few months, and that really is a big catalyst to own Yahoo. Twitter is a name I still really like, and I have 100% faith. Personally, I've added more shares at the $50 level, $52 level on a personal basis, and that includes also options, call options, because I think that the Twitter name and business strategy is to monetize their communication disruptive tool, and I think this will only be expressed in direct revenue numbers as we go forward. Splunk is growing at 50%. Yelp is growing significantly and had a great quarter. That's where, that's where the names that have revenue growth and earnings growth is in the tech sector. A Kellogg's or some of the consumer staples are growing at single digit numbers, 3 or 4%. They may have a 3% yield, but one has to use valuation in terms of, do you want to buy a consumer staple that's growing at 3% with a 2.6% yield, or do you want to buy an ETJ closed-end fund with a 10% yield and you're buying it at a 10% discount? So all those one has to balance and put together a portfolio that works.
Thank you, Todd Johnson and Mike Ray. This is the end of our podcast 2 for the Platinum Group. Please stay tuned for the podcast for the private group. Thank you.